I actually think, and I know this is kind of weird, people think it's crazy, but I think the Fed should be in charge of full employment and Congress should be responsible for inflation, right? Because they're creating it, right? 40 trillion, we're almost at 40 trillion in debt. That's Congress. They keep printing money and the Fed keeps monetizing the money, and it's a crazy thing. But my next guest, he thinks that the market is pricing in fewer cuts. He thinks that's a mistake, especially they think because of oil prices. So let's bring in out the Fed guy, fedguy.com principal Joe Wang. Joe, I want to share with the audience what they call the look-through, right? Been hearing about this a lot. The look-through approach reflects the fact that in the event of a shock that is likely to put sizable share of consumer prices under upward pressure, one option available to the central bank is the look-through. But Wall Street is saying, hey, and I think the Fed just now came out and said they think inflation is going to be an issue, not just for the rest of this year, but into next year as well.
So, right, Charles, according to standard central banking thinking, when you have a negative supply shock, like an oil shock, what you do is you look through it. There's two reasons for this. One is that monetary policy acts with a lag. So let's say you do something with interest rates now, it's probably not going to impact the economy until, say, 12 months later. And by that time, who knows what would happen in the Middle East. So you don't want to react to these short-term things. The second thing is that when you have these negative supply shocks, it's a one-time change in the price level. So let's say oil goes up, say $20, it's not going to keep going up $20 every year, right? So in a sense, it's a change in the price level rather than a change in inflation. Now, we've seen this Fed faithfully carry out this doctrine in the past. In 2003, when there was the Iraq invasion, we saw oil prices totally surge. At that time, the Fed continued to cut rates, and that was the right call because the military part of the operation ended very quickly and oil prices quickly went back down. And the same thing happened in the 1990s when we had Operation Desert Storm, huge surge in oil prices. The Fed looked through it, and the oil price shock was very much transitory. And today, I think that's the right thing to do. And I expect them to do that too. In the coming months, as we have more clarity as to what happens with the situation.
Right. Now, Joe, you also say that the Fed should be focused on jobs over inflation. There seems to be a tug of war within the Fed. Anytime a report comes out that's not inflationary, it looks like the hawks circle the wagon and try to come up with an excuse. They don't have to today with the PPI number, but why do you think right now, and I think maybe this chart explains everything that you're trying to say, but how do we convince the Fed that maybe we got a jobs problem in this country?
Well, we got to teach them how to read a chart, right? Listen, last year, when we were looking at every monthly jobs report, we were kind of upbeat, right? We were creating jobs. But after revisions, almost all those jobs disappeared. So we basically created no jobs last year. And more recently, we're losing jobs outright. And anecdotally, we hear companies firing employees and so forth. And maybe that has to do with AI. Maybe that has to do with poor sentiment. And again, we have this negative energy shock that's going to be impacting the ability of consumers to spend. They're going to have to pay more at the pump, maybe less money left over to buy other things as well. So I think the labor market is in trouble. In the Fed's dot plot today, they forecast that the unemployment rate is going to stay steady at 4.4%. I don't think that's realistic. If you look at the trend, it's clearly, the unemployment rate is clearly trending higher right now. There's a lot of headwinds to the employment market. So if they look at that, then I think that kind of takes care of inflation partially as well. Because if you have high unemployment, people are not going to be spending as much. Consumer confidence will be low. Right. And it's really hard to see where you're going to get that inflation impulse.
Hey, I just got 30 seconds. What's the biggest question that you want to hear asked of Jay Powell today?
I think the biggest thing I'm going to focus on is what is Chair Powell going to do after his chairmanship ends. Historically speaking, when a Fed chair's chairmanship ends, he resigns from the Fed and the president gets to appoint something else. If that's the case, that's going to change the dynamics of the FOMC. It's going to make it a bit more dovish because the president likes rate cuts. And so that's going to shift the trajectory of policy to be a bit more accommodative. Now, if he doesn't resign, if he stays there, he could end up being something like a shadow Fed chair and kind of, sway the committee because he has the gravitas and he has the experience and the relationships with them. So his plans after his end of his chairmanship, I think is going to be very important in determining the next step for monetary policy.
Yeah. I mean, you talk about, right now it's palace intrigue, but if he does what you say, I think that's a palace coup. We'll see. Joe, thank you so much. Always appreciate your work and your wisdom. Thank you.